disadvantages of the cash mode of payment. The advantage for the acquirer and also for the acquiree. So we discussed some of the advantages and disadvantages, and we highlighted that the cash mode is very successful and it will improve the simplicity, and it will create a greater control shareholders of the firm, where they are not going to be diluted their shares. It's just a cash payment. The deal is closed then and there, very clear. But then again, paying a huge amount of cash within one single event is not an easy task, so that's the main disadvantage. And we discuss about from a target company's point of view how this works. First main reason is the amount is clear, there's no hidden values there, the deal is clear. But also the disadvantage, you have to pay taxes the moment you sell your shares, because you are getting a huge lump sum amount to your hand. When it comes to shares as a payment, I just refresh from an acquirer's point of view. If it is a share option, there's no need to pay a huge cash amount, so the life is easy there. And also you can use this price earning ratio game into play. We discussed further on that. We call this, the Americans call this bootstrap method, where we believe when the companies get together, they are going to get the same acquirers PE to be continued in the future. So therefore, we use the price earning ratio game. We can use that. And also as a disadvantage, we said we take a risk of overpaying, and when there's will be a dilution of the existing shareholders' control, and so on and so forth. And of course, for you to have an exchange, there should be a quoted price. And to talk about the advantages to the target shareholders, we said again, we don't need to pay large capital taxes at the moment, and also we can share the benefit of the acquirer and for the betterment of the company. But as a disadvantage, the value is not certain, and there will be a higher transaction cost when there is a share option. So we will continue from there. So what I thought of starting with a question today on the things we have discussed in the last session, because this is a very practical I would say an area. Mergers and acquisitions is a very situation which happen on a daily basis, and a lot of new things are adding to the current literature and for the corporate world of financial management. So therefore, it's always something that we need to always explore and get an updated version. So therefore, let's do some questions and then we'll discuss further on this. So if I just take you through this question, there's two companies called XYZ and ABC, and XYZ Limited wants to acquire ABC Limited. So there are two companies. One company wants to acquire the other company, and there's an exchange of 1.6 shares of every share of ABC. So you need to keep in mind, this is not a cash mode of payment. This is a share exchange, and the share exchange is for one share of ABC, the XYZ is willing to give 1.6 shares, right? And it is anticipated to maintain the existing PE ratio subsequent to the merger also. What do you mean by that? Now we believe, price earning ratio means, very simply, if I just refresh, how many times or what is the value may represent from the number of times of this current earnings. So when the current number of earnings is high, that means okay, the company has a higher PE ratio. So it shows the number of times of the earnings where the value of the company represent. And therefore, they believe when X and Y Limited take over ABC, they may continue to share the same PE ratio of XYZ that they used to enjoy. In very simply, let's say let's simply calculate the PE of XYZ, then we'll get a better idea. So let's calculate the PE of XYZ. So how do we calculate the PE of XYZ? We have current earnings. We have total earnings of 1.5 million. We have total earnings of $1.5 million, and we have number of shares as 300,000. So if you convert in millions, is 0.3 million. It's 0.3 million. So if you resolve this, you may get what is the earnings per share. It's going to be 5. So earnings per share, EPS, is 5. Okay. So if you just calculate the EPS, it's 5 in XYZ. And what about ABC? What about ABC? So 0.45 million divided by, actually this should be not K, it should be K, not 75K, that is 75,000. So just a mistake, which I will correct when I'm uploading the presentation. So just ignore this part, please. It should be K. So if you calculate 0.45, that is 450,000 divided by 75,000, it's gonna be 6. So we got the earnings per share of the two companies, right? Now let's calculate now we have for us to calculate the PE, we need the price and the earnings per share. So have we got the price of the two companies? So that's also given. So then can we calculate the PE then? We can calculate the PE of the two companies. So how do we calculate the PE? Let's calculate quickly the PE of the two companies. Individually, we have the share price of 35 and EPS is 5. So therefore, PE of XYZ gonna be 7. And for ABC, it's 40 divided by 6. And that's gonna be, let's say, 6.67. So everybody clear how do we get the PE? Fine. So we got the PE now. Now what they say is, it is anticipated to maintain the existing PE ratio subsequent to the merger also, which means now X5Z before the merger, they have a PE of 7, right? And the ABC before the merger has a PE of 6.67. So what they say is, when the merger actually happened, the PE of XYZ is assumed to be continuing even in the future, even in the new firm, with the new, even at the post-merger situation, they are going to continue as the same anticipated PE of 7. That's what it says. All right. Now let's look at based on the financial data, what's gonna happen. So we are going to resolve some of these questions based on the information. Now what we got is the PE ratio and the earnings per share is there. So let's calculate what is the exchange ratio based on market prices. What is the pre-merger earnings per share and the PE ratio for each company? We already did that. What is the pre-merger means? Before the merger, earnings per share of the two companies and the PE ratio of the two companies, which we already done. So we have attempted the second one. And the third question is, what is the earnings per share of XYZ after the acquisition? So need to calculate that. And also, what is the expected market price per share of the merged company, the new share price? So how are we going to resolve these questions? The first one, what is the exchange ratio based on market prices? What do you mean by the exchange ratio? Exchange ratio means, now normally when it comes to a merger, by using, if you take an example of right, sorry for the inconvenience. Basic right, okay. So what we were discussing is based on the question to calculate the exchange ratio based on market prices. So when it comes to exchange ratio, we need to just have a look at the calculation we did. Now XYZ has a share price of $35 per share and ABC has a share of $40. So what they say is the plan of this exchange of shares are 1.6 shares of XYZ for every ABC share. So 1.6 of XYZ share is how much? We can identify that. So 1.6 into 35, we may calculate what is the price of the XYZ that we are going to share. And the share of the ABC is $40. So therefore, the exchange ratio would be I will write this here. Exchange ratio would be $35 per share into, we have 1.6, that's the ratio, and we divide by the share price of the ABC Limited. So what is the exchange ratio based on the market prices, not just based on the shares, because the share based on the shares is just 1.6 to 1. But if we look at the based on market prices, yes, it's going to be how much? 1.4. So even we say 1.6, when you look at the market price point of view, 1.4 times or 1.4 shares of XYZ, we are exchanging with the 1 share of ABC. Right. So that is the exchange ratio based on market prices. 1.4 of XYZ for a 1 share of ABC. 1.4 of XYZ to 1 share of ABC. 1 ABC. So this is the exchange ratio. Now let's look at the third situation. So we are done with the second one as well. So let's first and the second. So let's go to the third one. What is the earnings per share of the XYZ Limited after the acquisition? So now there's no more ABC. Why? ABC has been taken over by XYZ. So what is the new earnings per share? That's very important to understand the new earnings per share. So let's calculate the new earnings per share. Okay, so we assume when the XYZ and ABC join together, they may able to share the total earnings that they used to share alone. And plus keep in mind, we have not calculated the synergy benefit here. So let's assume the total earnings are 1.5 million and 0.45 million. So we can calculate the total earnings of the two companies, and we need to know what is the total number of new shares the XYZ has issued to take over ABC Limited. Now we calculate the ratio. The ratio is 1.4. So let's first identify how much of new shares the ABC has to issue, XYZ has to issue in order to take over ABC. Right. So how many shares the ABC had? 75,000. So in order to take over 75,000, XYZ has to issue how many shares? So let's calculate that. So in order to buy 75,000 shares, how much of XYZ shares has to be issued? So if we calculate that, let's calculate that. We have 75,000 shares. For 75,000 shares, we need to issue 1.4 times of basically for a 1 share of ABC, we need to issue 1.4 times of XYZ shares. So that means for 75,000 shares, we need to issue how many shares? 75,000 into 1.4 times. That's gonna be 75,000 into 1.4. Yes, 105,000 shares. So basically we are going to issue 105,000 shares in order to take over ABC Limited. And basically this is the value of the, okay, I think we need to make a correction over there. This is not 1.4. See, this is the exchange is the market based on market prices, but it clearly says exchange is 1.6 shares for every ABC share, so it's not 1.4. So it's not 1.4, it should be 1.6. So let's correct that, please. 1.6. So it's gonna be not 105. It's gonna be 120,000. Yes, right. Okay, sorry for the confusion. It should be 120,000. So very simply, ABC has to receive 120,000 shares of XYZ to make this deal. But when you look at the share prices based on the exchange ratio, it's actually 1.4 to 1. Right? So now this is the new shares issued by XYZ. Then what is the total number of shares? XYZ already has 300,000 shares and they are issuing another 120,000 shares. They are issuing another 120,000 shares. So then what is the total amount of shares of the new company? That's going to be 420,000 shares. So we have, so let's calculate the total earnings. That's going to be 1.5 million plus 0.45 million. That's the total earnings. Total number of shares is 420,000 shares. So let's calculate the new earnings per share of the company. So the new earnings per share would be the total earnings are 1.95 million the total earnings, and the total number of shares is 0.42 million shares. So basically if you divide by 420,000, how much is that? The new share is going to be 4.64. The new earnings per share is 4.64. So we are answering the third question, that is 4.64 dollars. $4.64. Right? And the last one, what is the expected market price per share of the merged company? What is the expected market price per share of the merged company? So what is the expected price of the share of the merged company? So I'll just give you 2 minutes to think of, to calculate the expected market price per share of the merged company. How do we calculate that? What is the expected price? So if you look at the question, we can use the PE ratio for you to calculate this. Yeah, we got an answer 32.2. Okay, yes. How do we arrive that answer? Now if you look at the question, it says, this is very important, anticipated to maintain the existing PE ratio subsequent to the merger. So what they say is, okay, after the merger, they're expecting to have the same PE ratio. So that means we already calculated the XYZ, the PE, that was 7. And we calculate the new earnings per share, that is 4.64. So based on that, we know the PE valuation method. So if our earnings per share is 4.64 and the expected PE for the future is 7, that's gonna be $32.2 for the future. This is the expected price. We don't know what would be the price they perceive from the market, but from this merger, this is the expected price, 32.2. Okay, so that is very important. So we resolve the last one as well. So first what we did was we calculate the exchange rate based on the market ratio. The exchange ratio was given, but exchange ratio based on the market prices we calculated, and the pre-merger earnings per share and the
Let's see, this company A has 200 million shares with a current market value of 4 rupees per share. Company B has 90 million shares with a current market value of 2 rupees per share. A makes an offer of 3 new shares for every 5 currently held in B. A has worked out that the present value of the synergies will be 40 million. Advise the shareholders of company B whether the offer should be accepted. Okay, just read it again and see whether you understand this. Let me quickly explain because of the time. Now let's say company A, 200 million shares are there. Each share is 4 rupees. The value of the company is 800 million. Company B is there from the other hand, where they have 90 million shares. Per share is 2 rupees. So the value of the company is 180. And then they say, if they are going to take over, there are going to be a synergy benefit. Another 40 million can be added. So it's going to be 180 plus 220 million. So it's going to be total 220 million. Now my question is this. If this is the case, what would be the value that we are going to offer from a B's perspective? Shareholders from company B, how much we can, whether how much we should take it from A, whether is it worthwhile for us. Now, first thing that they have said, we need to see the offer. They say company A makes an offer of 3 new shares for every 5 currently held in B. So now currently we have 90 million shares in B, right? So A is giving an offer. Look here, we will give 3 shares. A is saying we will give 3 shares for every 5 shares that you have. So you have 90 million shares, right? So 90 divided by 5 and multiply by 3 will give you, we can say, how many shares that the A is going to give. I'll repeat, 90 million, they say, we will give you 3 shares for every 5 shares that you have. So if you divide 90 by 5, you're going to get 18, right? Basically, you have 18 and then 18 into 3, you're going to get 54 million. So A is willing to give you 54 millions of company A shares to take over B. Now, when you calculate 54 million per share is 4 rupees. So 4 into 54 million, how much we are going to get? We are ready to issue 54 million of shares for 4 rupees of each. and that's going to be 54 into 4, 216 million. Are we clear? How I get 216 million? I am going to issue 54 million shares to B to take over the entire company. How I got 54? For every 5 shares of B, I am going to give 3 shares. So for 90 million shares, I am going to issue 54. Right? Then 54 into 4, I got 216. And for B, they know their actual worth is 180 million. But somebody is going to give them an offer of 216 million. What do you think? They are going to get a premium price for their share. And from A, actually, when you take over this particular firm, the maximum value that you can generate is 220 million. But by giving 216 for B, you are anyway giving most of the benefit for the company B's shareholders. Your return is only 216 minus 220 is only 4 million. So the advice for the company B shareholders is get this offer. It's a good price for you. Are you clear on this question?
Now, so far we were discussing about mergers and acquisitions. And I said that mergers and acquisitions, I refer this as a corporate marriage. They call corporate marriage. The Wall Street journals refer this M&A as a kind of corporate marriage. So we discussed there are 2 types of acquisitions and mergers can happen. One is the friendly takeover. The other one is the hostile. So these are some of the key areas that we need to discuss. So the strategies, or you call the defense strategies, or the techniques the firms take to be to avoid these hostile bids. Now, hostile bid means without a consent, one firm is going to take over another firm. So there are a lot of examples we can come across where the companies has taken a lot of defensive strategies to get rid of this situation. So some of these are, first one we call the shareholders' rights plan. You call this poison pills. Now some of you all may confuse what is this poison pills means. Okay, so now pill is a kind of a, we call a tablet. Okay, and so poison pills means like when to avoid or to make sure that you will not be taken over, you're committing suicide, or company is committing suicide. So you call these poison pills. So what do you mean by these poison pills and how it works? Now, any arrangement a company will come up with from the existing shareholders, which make sure that the company, the acquirer can't take over. Now, if you take an example, let's say, we'll take a simple example for this. Let's say company A is really interested of taking over company B, but company B is not interested of being merged or acquired by company A. So we take lot of strategies to safeguard that company to be taken over by A. Okay, or being taken over by A. So we take these poison pills, means the B's shareholders, what they decide is they will sign contracts saying if company A take over us, right? If company A take over us, we are signing to settle all our liabilities of the company B. So if we settle all our liabilities, of course we might have to sell all our assets. So that means we are asking for trouble, or in other words, we are committing suicide. Why we are doing it? We are threatening to A, look here, if you take over us, this is what we are going to do. We have already signed the contract. If you take over, we are going to sell all our assets and settle the liabilities. Then A is thinking, okay, my God, if you are going to take over B is going to settle all the liabilities and sell the assets. So then what's the point of taking company B? So they will have a second thought. Are we going to take over company B? Why? Company B sometimes may be attractive for certain reasons. Now, as I told you at the beginning, why the company is thinking of mergers and acquisitions, there were a set of motivational factors. We discussed it may be synergy effects, it can be a unique asset they have, it can be a patent or a license they have. Because of that, A want to take over B. So what B is saying, look here, if you take over me, I'm going to sell my license. That's the contract. So if that's the case, A is a little bit scared to take over B. Why? If you take it, then B is going to be committed suicide. So you have you're a little bit laid down for that decision. So there are a lot of poison pills in this corporate world. They sign agreements to sell all their assets. They sign agreements to settle all their liabilities. They sign agreements even to buy shares on a half a price. And there's something called green mails where the employees, they are signing the contracts. Okay, sometimes the A is interested of taking B because of the talent workforce. So what the B is saying, okay, if you take over us, we are going to basically we are leaving the company B. We are taking a huge voluntary package, redundancy package, and we are leaving. So the B will not be able to survive the amount of the money that we are taking because as the voluntary package. So A will not be attracted to take over B because they know once we take over B, B is not be able to get the benefit for us. So therefore, all these poison pills in the corporate world are used to defend A taking over B. And there's something called white knight bidders. Now, have you heard of these white knights before? This is in the actually, sorry? Exactly, yes. So there's a, nice story behind it. Now, white knights, they're called black knights and white knights in a kingdom. When A is going to take over B, where B doesn't want to be taken over by A, B speak to company C. Okay, look here, A is going to take over us, which we don't want to. Why don't you take over us? We call a third party to take over B, so that B will not be attractive to A. Sometimes with the B and C merged, it will be too large for A to bid or take over, or B may have more strength, financial strength, where we can't touch anymore. So these white knights bidders, the story comes where when the king wants to the princess to be married a specific night, where the princess doesn't want to get married with this particular knight, what she says is she called her preferred knight, and they call this white knight and ask him to take her away. So these white knights come in the night. That's they call these white knights. White knights come in the night and gone away with the princess. So that's why we call these white knight bidders in the corporate world. So you go and talk with the C and say, look here, A is going to take over. Before that, please take over us. So they sometimes these are most of these white knights are the investment companies, investment banks. They go for investment banks and say, we are happy to be taken over by your company. Please try to give an attractive price than A, so that in friendly terms they will negotiate the deal. So these are also in the corporate world. And the other situation is the management buyout. So sometimes we discuss this. The own management of the company is going to take over the firm. And there's another called Stagger Board. Now, Stagger Board also something which used in the corporate world. for these as a defense strategy. So we'll be discussing one by one, and instead of okay, I will explain further. And plus we have trigger acceleration of debt repayment. This is a part of the poison pills. Very simply, the company B is going to settle a lot of debts that they have by selling off their assets. So when they start selling off their assets and settling debt, the attraction for A is not going to be there in the future. So some organizations take this option for as a defense strategy. And the litigation is also common, where the B has the right to go to courts. Look here, A is going to take over us, which we don't want. Please stop this. They're going to get the legal, the safety, or the we get the blessings from the legal authorities, and they are trying to tell to the fair trading commissions, this is not going to be good, this is not going to be healthy for our current shareholders, so please stop it. So they are telling the authorities, like we go and tell to the policeman to stop something, they will go and tell to these legal authorities to not to go ahead with this deal. So these are some of the things. So these are some of the things I explained. Another one we call these golden parachutes. Now, the golden parachutes, again, a contract designed to give executives substantial compensation if they are dismissed following the takeover. It's like this. Now, we know that one of the reasons B doesn't want to be taken over by A is the moment when they take over, the management of B has to go home. They will be sacked the current board of directors. So what they do is they will design contracts now. Okay, look here, if A take over B, we have signed an agreement. We are giving for our executives some substantial compensation, probably like huge voluntary redundancy packages if they dismissed. So then A know before taking over B, look here, if you take over B, we have to pay a huge amount for the current employees, which is something risky to now take. Okay, so this is another poison pill. So in the corporate world, especially US, when the markets are saturated, one company is always trying to take another firm to expand. So what they do is they will come up all these tactics to defend themselves. So in US, these poison pills are very very famous, and one of the poison pills, again, which I was explaining, golden parachutes. Right, and so there are a lot of types of golden parachutes and poison pills. So this one also I explained, poison pills, flip overrides, allowing holder to receive stocks in the acquirer if the bidder acquires 100% of the target. So basically, if they acquire the full firm, they will get some extra rights. Normally these employee rights can have a maturity of 10 years. So they will sign out these agreements before they are taking over to avoid these things. So you can read some of these things in the journals. Those are very interesting ways how the companies defend themselves. But then again, in the corporate world, even though people are coming up with a lot of poison pills, again, another group are looking for antidotes to how to get away from that also, because they want to somehow merge with another firm to improve their business. Again, poison puts bonus issues that becomes due in unfriendly takeover. So there sometimes, if you take over us, we are going to make a huge bonus issue which will dilute the entire share structure, and then you won't get that 50% because of the new bonus share. These are all agreements, pre-agreements. If you take over, we are going to go ahead with this. So we are signing up some agreements. Okay, and we anyway discuss about the white knight strategy. So we have, I have explained further for you to get an idea what is this poison pills and how they launch and what is the impact of it. I'm not going to go into detail of that. And the white knights, how they work, and the friendly takeovers and how they work in the real world. Just you can read that section as well, white knight bidders. And this is what I want you to explain more. Stagger board. Now stagger board is another defense strategy, especially used in US companies to avoid getting merged with another firm or acquired by another firm. So what they do is, now we believe that the board of directors has to be appointed every year. Now they are signing agreements. Some directors you don't need to be appointed every year. Okay. Now if you take an example, if company B is going to be taken over by company A, what company A has to do is they need to deal with company B management, the directors, and they need to have some dealings with them, deals. Okay, so they are also like today's politics. They want to get the power, so they need to try to deal with small parties and the MPs to take on over power. The same situation when a company B is going to be taken over by A. So what the B is doing is they are coming with another strategy where they will make an agreement. These directors will not be able to change on a yearly basis. So what happens is, these directors, when they are not elected on a yearly basis, even the company, if A take over B, now B, A can't put their own directors as they wish. Why? There's a group which has been already appointed by B, and they will take a long time to replace. Why? They are not happening on a yearly basis. So then all these things, what happen is, it will slow down this acquisition and the mergering process. Because very simply, if I want to take over another firm, I need to speak to their management, the directors, and try to get the majority. Let's say one director holds 20% of the shares, another director holds 20% of the shares. Now these two directors are the key components. If I want...
Okay, these are a couple of examples that you see in Sri Lanka over these years, some of the mergers and acquisitions. So SLT took over Mobitel. It's a 100% subsidiary takeover, fully owned subsidiary. So these are some of the mergers and acquisitions happen in Sri Lanka. Just for your information, I have this down. But every day, every year, you will see a lot of acquisitions and mergers happen. We have Aviva, NDB, and also international firms as well. So sometimes when it comes to company takeovers, we see a lot of conflicts are coming. Where country-wise nations, we have conflict with nations. Where let's say the mother company is the US company, when the Russian company is going to take over a US company, they are very against that. Chinese, Russians, Indians, Chinese. So you see, when these companies are, even the corporate mergers and acquisitions are happening, you see a major force coming from the nationals because they have conflict with each other. And then ethnic conflicts, Christians versus Muslims, Muslims versus Hindus, because the company's ownerships also matters, and because of that, there will be clashes between companies, and then acquisitions, mergers sometimes happen hostile way in the real world. Okay. And keep that in mind, any merger and acquisition cannot be successful without the employees' help. This is the best example that I can take for HNB and Sampath, when the HNB and Sampath was trying to be merged, the employees were fully against that. They continued to strive and strive. As a result, ultimately, managements of the two companies decide to give it up. Even they pass resolutions where shareholder rights arrangements to avoid the merger. So these are some things for you to read, and this I'll quickly go to this one. So why these corporate marriages fail? Let me quickly tell you the main reasons. These are all done by research and surveys. They say even though a lot of companies are merging, corporate marriages are happening in the world, there's a very high rate of failing, right? So why these divorces are happening? First one, target management attitude and cultural differences. If you really look at it, these are very same for individual reasons for divorces as well. The attitude of the two teams, managements, and cultural differences. When there are cultural issues, it will lead for a breakup. And then little or no post-acquisition planning. Now they plan everything until to get married. They don't plan after that. They don't see how they are going to raise children, how they are going to do this, that thing, what is their school, or what is their house, where they are going to stay. Nothing is planned. So after that only they think, and then there will be arguments and there will be clashes. Similarly, the organizations, they plan only to take over. Now this is example we see in governments also. They want to somehow win the election. After the election only they really plan how they are going to run the country. So they don't have any post-acquisition planning. So when you have those things, there's a high chance that you fail later. Because after you take over the company only you plan, okay, how it's going to be the new structure, how it's going to share the money, how it's going to close down the business, how it's going to, some of the business units, how it's going to redundant the employees. If they didn't plan anything before that, after you do the acquisition, there are going to be very big clashes. And then lack of knowledge of the industry and the target. This is simply sometimes before they marriage, they think they know everything. After that only they realize they don't know any about the other partner. So the businesses also, firm badly want to take over the company and then they realize we don't know anything about the industry. So they don't know how to manage it. Poor management and management practices. So this is also very important. If they don't know how to manage the new environment, change management is not there, it's going to collapse. And little or no experience of acquisition. They don't know how to do an acquisition also. And when they don't know, then there will be a very high failure rate. How merger and acquisition be successful? How we can avoid this situation? How can this divorce can be a sustainable and a more successful marriage? First one, detailed post-acquisition planning and speed of implementation. Before they go for this corporate marriage, they have to have a very detailed plan, how they are going to do it, the post-acquisition plan. Especially who are going to be redundant, you need to prepare the list. What kind of products they are going to stop, what kind of operations they are going to cease, what kind of business units you are going to sell, what are the assets that you are going to take over. All that has to be properly planned. And there should be a clear purpose of making the acquisition. You need to be very clear why you are taking over this, not for fun. You need to have a strategy for that. And you need to have a good cultural fit. You need to know, okay, if you go with this company, whether it will be culturally fit. Let's say suddenly a very stable and a conventional organization is going to take over a software company. There are going to be a cultural clash. They are complete the way of dress, the way of behave things, how they do business practice, open cultures. And they do, some people, companies, they want people to call sir, madam. Some companies, even the CEO, they call from their first name. But so if there is no clear culture, there are going to be a disaster. high degree of management cooperation. Both the companies management should be agreed to convince and discuss and sit down and negotiate. If they are demanding, if husband and wife has to cooperate, if at least one person has to cooperate, if both want to fight with each other, there is no way that you can continue this corporate marriage. This is exactly the cooperation between two managements. In-depth knowledge of on the acquiree and the industry. Get to know very well about the details of the partner and understand the person, understand the industry, management, and the business before they going to be going for this mergers and acquisition. So if you do that, they say they can overcome this situation. Having the right strategy and be more realistic and strong integration plan. So if they do that, they say corporate marriage can be successful. With that, I would like to conclude my presentation.